Well, we're on leases, and leases is one of the more complicated topics we have this semester. And I think one of the problems is that there's a lack of reciprocity, and talk about that a lot. One company's accounts payable is another company's account receivable. One company's revenue is another company's expenses. And when we get into the operating leases and we talk about operating leases and we have lessor and lessee, it kind of goes away. We don't have that reciprocity that we would expect. The other concept that makes it difficult is the present values. We're returning to present values. And the amortization schedule you learned in bonds, it was so important that you learned it. You got to relearn it. And you learn it in a different way when you're on leases. So the first thing, of course, to do is to understand the difference between a capital and operating lease. And you had that in the first part of the leases, and I'm going to go back over these problems with you. And then after we do that dichotomy, the next thing we do is, so we have to know what is a capital lease and what's an operating lease, and that's a concept question, and it's substance over form. What is it really? And then the second one, you have to know the criteria because you got to put it into a category. Is it a capital, and we also call this finance lease, or is it an operating lease? It's one or the other. And then we have to talk about how you do the accounting. How is the accounting done for these? And then there's another step with the capital or finance lease, as if it's a sale of a product. You know, my analogy here is if you had an accounts receivable and you made a sale, you record an account receivable sale. You would debit cost of goods sold, you would credit your inventory. You're going to do exactly the same thing in your journal entry here if you are selling a product through a lease, because if you're selling a product through a lease instead of accounts receivable, you record it as lease receivable. So the profit comes in at the beginning when you have a capital lease and the lessor, the owner, is selling. That you are going to have the interest revenue which comes over the course of that lease, but the difference between cost of goods sold and sales is going to hit the same way as if you were selling it with an account receivable. What happens to the right to use asset? Well, we used to put these on the books of a company when the capital finance lease was initiated and the lessee started it. We would put it on the books and we would call it an asset, just like a fixed asset. And the problem is that the one who's leasing it doesn't really own it at that point, do they? They just have a lease. So we got to come up with a term for that, and we call it a right to use asset. And instead of depreciation, you do amortization, and generally this thing is done as a straight line method. And there's no residual because it's just a right of use, right? You don't own it. You can't sell it at the end of the lease. If you could sell it at the end of the lease, you'd have residual value, but you don't have any residual value with the thing. So it's just amortized straight line generally. There's an exception. We get into that when we talk about our operating leases. Now, how do you account for an operating lease? Oh, this is the confusing part because the lessee is going to do present value calculations and still create a liability, but the lessor doesn't. Shortcut method has to do with when it's a short lease term. Just like in the previous chapter or module when we were talking about the contrast between non-current and current liabilities, and one uses present value, one uses maturity value. It's a similar thing going on here. I talk about it a little more when we get into in the lecture on the second part of leases in that lecture. But the shortcut method, it's because it goes away in such a short period of time, even though there are material differences. Say if you're looking at the quarterly financials, if you looked at the annual situation, not much difference because it goes away so quickly. Least uncertainties. Generally, I'm going to say about this, it's substance over form. And also the key words here are reasonable and certainty. If it's completely uncertain, then you can't really act upon it. But if there's some reasonable level of certainty associated with something happening, then you have to get it into your accounting system. That's the general rules you should know there. So the uncertainty in the reassessment business, I tend to not give you too many problems about that. I tend to de-emphasize that. I do believe that most of the other stuff you should be able to handle and you should understand quite well. On 8, we have BPO and we have residual value. BPOs and residual value. Well, what about the BPO and residual value? Well, those need to be taken the present value of 1 to those because they end up being treated as if they were cash flow streams. Now, they're not cash flow streams because a residual value only will be a cash flow stream if the item that's going back to the owner doesn't have that residual value. So, and the other thing to say here was when I say residual value, you're going to assume I mean guaranteed residual value. Okay? But otherwise, you tend to handle it pretty much the same way. So if you understand those concepts and how to work through a problem with that, I'm most happy. This is a brief exercise. It's kind of there's 2 of them in a row, very similar. Non-specialized is one of the criteria, and then it says an 8-year period at which time possession will revert back. That means that there's no transfer of ownership that's pretty much expected to happen. Its cost is $16 million, the useful life is 12. So what you basically need to do here is go through the criteria, and they gave us a fair value of the thing, and the fair value here they're going to say is sales price, and the amount of the present value is 20.6, and the fair value is 22.4, so that becomes 92%. The other thing to look at and to figure out in your problems, so the first thing is to see what is it? Is it a capital finance or is it a operating? And if any of those criteria are met, in which the first one, the one with the present value here is met, then you have to call it a finance. So this is a finance lease. And then the other thing is it talks about this and it says the sales price in it. So because they said sales price, it's a sale. And if it's sale, then you're going to have selling profit. And how do you calculate the selling profit? Well, as I said earlier, think of it the same thing as if you were recording an accounts receivable sales type transaction, and except the value you're getting in is going to be a lease receivable it's going to be recorded as a lease receivable, and the lease receivable value is the present value calculation. And then when you get to the amount of profit, down there is going to be the cost minus the 20.6. So the 20.6 is the sell price, and this is the cost of goods sold. So that's your corollary, and that's how it's handled. Now there's another flow that's going to happen, of course, with the revenue that's going to happen, and that's going to be the interest revenue coming in. On the second one, we have a situation here working through that, and you see that the present value of the payments is also met on this one as you work through it. And I don't think there's anything here about it having a cost, and so it's equipment that cost the company something here. This is not considered a sales lease, and so they're going to call that just a finance without a sale. A finance lease agreement calls for quarterly payments over a 10-year lease term, with the first payment on July 1st. The annual interest rate is 8%. Both the present value and the cost are $150,000. What would the amount of interest expense the leasee record in the second quarter payment? And what would the interest revenue that the lessor records in the second quarterly payment? So if it's the first quarterly payment and it's the beginning of the term, that will be the first payment that's taken out at the time period at the beginning of the lease. There's no interest on it. And this is where it gets tricky, because you have to remember that that first payment, all of it then goes down to pay the present value amount of $150,000. So when you get to the second one, you're calculating interest on the amount that's outstanding, which is the $150,000 minus the quarterly payment that's made up front, because it's an annuity due. So when we calculate it, there's your calculation. It is the $150,000 minus that first payment, all of which goes to paying off this. And again, my go-to reason for this is to have interest, you have to have a passage of time. There's no passage of time. It's you literally, before they leave with the equipment, they're literally writing a check that pays down what they owe. So it's a matter of minutes if you want. There's no time lapse there. So this is a calculation. If you have quarterly, remember the interest rate they give you needs to be divided by 4. And also when you're working with your annuity tables, remember that the time period needs to be the period is actually the quarter, so the number of periods increases. When you do the journal entries, if you did this, the one who is taking it out would record it as $150,000, and they do not show what would also be happening here. And instead of depreciation, you're going to do amortization expense and right-of-use asset equally over the time period. So the $150,000 needs to be taken out equally over the lease term. Now, if there were a transfer of ownership, you're going to extend the period of time in which you take the depreciation. You're going to spread it over a larger time period, because you're going to be looking at useful life when you take that right-of-use asset amortization. Here we have a finance lease. They don't make us go through the dichotomy or the check thing on it. We know automatically that it is a finance lease, or sometimes I slip and call it a capital lease. It has the same as the asset's useful life and the lease term are the same. Recall that it doesn't have to be the same for it to be a finance lease, but that's one of our criteria we look at, and 100% is certainly greater than our break point for that. Interest rate is 5%. The lease liability that they record at the end of the first year. To work through a problem like this, I absolutely say you should just schedule the thing out. And one of the things you need to do is you need to go in and you need to figure out what the present value of that is. Here, they calculate that. I've got to move down a little bit on our screen so you see the calculation. If they don't tell you this number in the problem, if they don't say the present value of the lease payments is, you're going to have to do the calculation. You're going to go in there and you're going to see that. Now, there are no bargain purchase options here. There are no residual values, so you don't do a PV of 1 calculation. It's all taken care of here, and it's just those annual lease payments that are being made. And this is at the beginning, so it's an annuity due. Make sure you've got your right annuity due here. Annual, so your payment period is just 1 per year, and the interest rate is this, which is the annual rate of 5%. We get 140. When you do the calculation, you get some number that's really close to 140. So if you were a little bit off in that calculation and you went on and did your journal entries, it's not going to be a material amount of difference. So here you come up with that, and you figure out the interest on the balance sheet at the end of a time period is going to be $56.87. Now you're going to say, but that's not this. The whole problem with this problem is we are starting in January 1st and we're doing our financial statement at December 31st. And you're going to say, well, at December 31st, they have not paid any interest. Yeah, that's right. They haven't paid the interest. The interest will be paid in a part of that $26,269 payment, which is going to be done on January 1st. Because we got accrual accounting, you are going to assume the whole 365 days of it is showing up at December 31st. Technically, yeah, technically we should wait, and we should have said 364 over 365 times the 5687 should be the amount of interest expense for the first year, because that last day has not lapsed. I get that. I get it completely. But in this class, if you see December 31st, I want you to say it's the same thing as January 1st of that next year. So just put 5687 in there. And it is properly called an interest payable, by the way, because again, we're going to turn around and pay that then on January 1st. They are contemplating an agreement to lease equipment for 5 years and normally sells for $100,000. 8% is a reasonable rate of interest. What is the amount of the quarterly lease payments? Well, you got to take the 8%, divide it by 4, get 2%. And instead of 5 years, you actually have payment periods of 5 times 4, or 20. So doing that, you get something like this. Now, all this is just going to do here, it is set you up for doing your amortization table and working through that. So this is just a part of that. No journal entries were required with this problem, and they're not even asking you to determine anything about financing or operating leases. Operating leases, that's the topic our last module, or last part of the module, I should say, is. They leased equipment to LTTC under a 7-year operating lease agreement. One of the first things I always tell you to do in these problems also is to pick out who's the lessor and who the lessee is. And it appears that Lakeside is the owner. They're the ones that are leasing it out. And LTT Corporation is the lessee. And the rule, I would say, is in almost every situation, the lessee has to record a lease payable. And the amount of that lease payable is the present value of the flows, right? It's the present values. Annuities, bargain purchase option, residual value, whatever, that's almost certain you're going to have to do this. What's the exception? The exception is if it were a finance lease in a short period of time, then you get away with doing things differently. This is not that exception though, because you're going to pay 7 years of it. Okay, so general rule, lessee has to record a right of use asset and a lease payable for the present value of the streams. We know that. What will be the effect of the lease on their earnings in the first year? Now, who is LTT? LTT is the lessee. What does the lessee pay? The lessee has to pay interest and is also making a payment which goes down toward the lease payable. Okay, so what affects the income statement for them? Well, that interest expense hits. Now, the other thing you're going to see that you can't forget about is you created a right of use asset and you're going to have to take it down, right? Now, operating leases, what's the rule on that? Well, operating leases, our total rent expense needs to be the amount of the payment. So we need to come up with quarterly rent expense of $25,000 each quarter. So what does that mean? It means we need to have how much for a whole year? That's $100,000. Okay, so that's the answer to the problem. Now, they went in and they actually went through all the criteria and said that none of the criteria is met, and they gave them to you. Do we have to do that? No. So if you get a problem and it tells you right in the problem and it's an operating lease, there's no need for you to go through the criteria and figure out first, is it operating, is it finance? You've got it. It's an operating lease. And as I said before, operating leases, if you're the lessee, the one renting, assume you're going to have to do the present value calculation and record a lease payable. The trick about the operating lease that makes it look different from a financing lease for the lessee is that the lease expense or rent expense, however you want to say it, is going to always equal the payments. Alrighty. This one is here. $2 million, useful life of 12 it says, what are the earnings on the first year? Assuming straight line, there's a depreciation, so earnings are increased by a net of, yeah. This one is a little bit of a question because they're asking you to take into account the depreciation. Uncertainty in lease payments. When there's uncertainty associated with lease payments, and there's so much uncertainty that you can't say that you're reasonably certain, you generally do not include them. Okay? There are two exceptions. There are two exceptions to that, and the exceptions are listed here. And when you have these two exceptions, then you should change the way in which you record things. Otherwise, you don't. So, in this case, they said that you should go up here and you should figure out, this is an ordinary annuity because the payments are due at the end of the period of time. That's another thing to take into account here. You're going to use that, and you're going to go in here and you're going to use the basic 4-year period, and you are going to ignore the other things here because there's too much uncertainty. I spend a terrible amount of time on that one because I think you just need to understand the concepts of it, not so much how to work it. BPO, a bargain purchase option. What is that? Well, we don't usually use the word bargain with it anymore, but we say it's certain or reasonably certain that the individual who is the lessee is going to buy it at some point in time. And it could be at the end after they've made all their rental payments, or it could be sometime in the middle of the lease when they haven't even made all their payments. If you have a purchase option and you believe that it will be exercised, you should do your accounting as if it were exercised, which means you need to take the present value of the amount going back to the beginning of the lease, present value back to the beginning of the lease date, and it's a PV of 1 because it's an amount that's going to be paid. So here we have the option up here to purchase the machine at the end of the lease term for $100,000. Well, you need to use the 100,000, okay? Because it says when it was expected to have a residual value of 160. Well, what are they saying when they give you that? You don't use 160 in their calculations, but you're going to say, when I look at this, a reasonable person would use the option and then go out and put that item for sale somewhere. They bought it at 100,000, sell it, they make a 60,000 profit, right? So a reasonable person would do it. That's all they're trying to tell us with that residual value. It doesn't go in the calculation anywhere. And the total amount, which you need to show as the lease payable, the total present value calculation, is going to be a combination of two things. It's going to be a combination of the PV of 1 for the 100,000, which is here, and then it's going to be also a present value of the leased payments. In this particular problem, they don't give you they don't tell you the information you'd like to see. Okay, they tell you the total value of the thing is 600,000, and you know the 600,000 is going to be made up of two components: the PV of 1, which is applied to the 100,000, and then also the PV, which is applied to the annuity payments. So the total amount which you have to recover from the annuities must be this amount. You know the years, you know the rate, you go back and you can figure out, dividing by this PV factor, you figure out what your payments are. It's a complicated thing, isn't it? So most of the problems you're going to get, they're just going to tell you what the lease payments are, and that's good when you have one of these problems, because really in a sort of thing like this, it's a lot of extrapolation to figure out what combination gets you to 600,000. And sometimes you're trying to figure out what the effective interest rate should be. You know, there's this much at the end, there's this much in these payments, and you have to try to figure out what to do to come up with an amount of 600,000. This problem, lucky for you, they gave you the interest rate. You didn't even have to come up with that. It's just a matter of plugging things together. And there may be some amount of rounding done in these, and it might not come out quite so neat at exactly 600,000. With residual value, it's handled exactly the same way. You have amount to be recovered, you have a present value, you have this amount coming through those payments. You figure out the factor on this and you get this. It's wonderful, okay? For your purposes, you need to understand this amount at which you are going to record your lease payable, or if you get to record it as a lease receivable, then this 700,000 that goes on the books is a combination of two present values. It's the present value of the residual using PV of 1 and the present value of the annuities. An annuity will either be a due or not. Now, guaranteed residual value, at which time it goes back to the owner, and they are going to be paying the lease payments and the $36,000. They estimate that the residual value will only be $35,000. Well, if they know that they're going to have to come up with an extra amount because they're going to have a shortage, they added it back in. This is very good for you to go through this and see if you can come up with the right solutions. And I give you those solutions below, and I talk about why. So can you apply the criteria? I expect you to know the criteria. I expect you to know the percentages, the cutoffs, all of that. So you work through this problem and you figure out whether it is a operating lease or whether it is a finance lease, and you classify it appropriately. So I'm not going to go through these steps for you. I expect you to be able to look at all these situations. And the asset's useful life, you're going to say how much of it is covered. So that's a fractional computation. You're going to have to calculate the present value here to determine the way in which the fair value relates back to the present value, because there's a that 90% rule, and in this they do not give you what the present value is. So one of the first things you need to do here is calculate that. The other thing here it's rather important here is the annual lease payments, either coming at the beginning or end. Remember, at the beginning it's called due, and at the end it's called ordinary. That really does affect what you use to come up with the calculation, because you're going to take a present value calculation on 10,000. Nice part about this is all annual. You don't have to do anything with those interest rates to adjust them. So you can work through those. This is a very good exercise leading up to your exam. Here we have quarterly payments at 2 years, so that means you'd have 8 periods of time. If 8% is the rate for the year, then for each quarter 1/4 would be 2%. Prepare an amortization schedule and journal entries. Wonderful exercise. I encourage you to work through this. And this is the manufacturer Southern leased. They are the leased from. They are the lessee, and the lessor is Edison. So first thing you need to do is look at Edison, who is the owner. Edison purchased the equipment at a cost of this amount, and then they are going to turn around and they are going to lease it out. Now I look at this and I'd say, okay, if the owner of it purchased it for the same amount as probably the selling price, then what do you think? Do you think this is a sale situation or not? And I think what they're going to want us to do here is do the journal entries, though, for the one who is renting it, the lessee, because that's what it says up there. We could do either one, and you should be able to do either one. The lease payments are $15,000. The present value of that gets us up to $112,080. You may round to dollars. It probably makes your work easy. Notice here the fair value of the asset was $112,080, which is also the same thing as the present value of the stream. Whoa, 100%, right? And that's one of the criteria. Certainly above 90% at 100%. Creating this schedule, the only difference between this, now, if it's between this and some other schedule you might come up with an annual, is that the lease payments and the interest rate has been adjusted, so the periods of time changed. Now the total decrease in balance is to that, so it's going to go away to 0. You had to adjust here. I call this fudging. They adjusted a little bit. That's the amortization schedule. They record a right-of-use asset. They also should be amortizing this right-of-use asset. They do not show those journal entries happening here periodically. So anytime you do depreciation, anytime you do amortization, you should be doing it periodically. Instead, what they're doing is they're taking it at the end of the year period of time. So it depends on if they're doing financials whenever they're doing them. This is a type of adjusting entry that needs to be done. As I said before, when you lease something, there's no amount of residual. There's zero value at the end. So when you amortize that thing, you're going to do it under a straight line basis. This was not an operating lease, right? Because we said 100% of the fair value. So there's no need for us to do an adjustment here, which takes the amount of lease payable and calls it amortization expense. Instead, each one of these times, they should have just done a journal entry, which took a portion of this 56040. This journal entry, as I'm saying, should be done at least here, 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 every time all along the way. Notice in December that there is no interest, which is actually paid, because you turn around and you pay it in January. Sales types lease with no selling profit. Oh man. Okay, so they're selling something with no profit. And I don't even know if I like calling it a sales type lease. I would call it a financing lease, okay? Because there's no selling profit. I'm not going to consider it as a sale of inventory. What kind of person would sell their inventory at no profit? So here you go through this and you work through it, and I think we already came up with some dollar amount for it. And the lease amortization schedule looks like this. And this is when we are looking at the lessor's books. And the lessor is going to take the equipment off their books, and they're going to consider it as being sold, but they're not going to record it as a sale transaction. I'm going to tell you a little bit more here than you're given in this chapter. If we had equipment and we are the lessor, we normally would have recorded depreciation on it, wouldn't we? And if we get rid of that, what we do is we credit the equipment, we debit accumulated depreciation, we record a gain or loss, depending on the difference between that and what we get in, and it's usually cash. Instead of getting cash in here, we get a lease receivable, okay? So normally this first transaction, they gave a little bit of a shortcut when we went through this, because normally when you get rid of PP&E, property, plant, and equipment, you take it off, you remove everything that has to do with it, the accumulated depreciation, the equipment from their books, you record a gain or loss, and you record something coming in, right? Instead of selling the thing for cash, we sold it for a lease receivable, a right to receive lease payments in the future, okay? So they took a shortcut here. They did not tell you what the accumulated depreciation was on this. It would need to be removed. Also, the equipment would need to be removed. And a gain or loss recorded, because I really seriously doubt that the lease would be exactly for the same amount as the carrying value of that equipment, right? So they do a shortcut in all your problems. Now, you take it off the books. You take your equipment off the books. And then what you do, you turn around and you record on the very same day cash coming in. There is no interest in this cash because it's the same day. Time is not passed. You do not get to record interest revenue. However, in subsequent payments, you will have interest revenue because there'll be time between January 1st and the next period of time and when you're paid, which you should be receiving interest. So they calculate your interest revenue here as a difference between the outstanding balance. Well, the outstanding balance has been reduced by the $15,000 times the 2%. Now, there's no depreciation taken on this thing because we took it off the books. We took it off the books. So some of the trick questions you get on these have to do with depreciation. If you take it off the books, so if this had been an operating lease for the lessor, then the equipment would not have gone off the books. We would have recorded depreciation, and we would not have recorded a lease receivable. We would have not done this journal entry right here if we had had an operating lease and we are the lessor. What would happen with this here? This would not be called lease receivable. This would be called revenue. We would have recorded all of that as revenue. That's the difference between recording something as a finance, and I use capital lease, or operating lease. This is a finance lease. Operating lease, this is not going to show up, and this is going to be revenue. Okay. And what about this? If it's an operating lease, we don't take the equipment off our books, so we have depreciation. Well, these are all repeats, aren't they? And you have to build that schedule, so it's very, very important you know how to build a schedule. Keeps going, keeps going, keeps going until, I guess, you get down here and to the very end of the thing. So, if you took it off your books, then that's basically the end of it. All right. Lessor has an operating lease. So again, it tells you here that it is an operating lease, and they acquired for a fair value, and then you would go through and work through this. The lease is deemed to be an operating lease, so I don't have to go back and look at all this stuff and calculate and figure out what it is. This is the lessor. They tell you that here, which is nice. So this is the lessee because they leased, and this is the lessor because they're the one that supplied it. So this is nice of them to do that. It's an operating lease. Operating lease, and the owner is doing something. And so they want to know what the effect is on that. On an operating lease, remember, if it's something that has depreciable value, the lessor would be taking depreciation. And then all of the payments that come in would be revenue. Now, what's the effect on the balance sheet? Well, on the balance sheet, if it's operating lease, then if we're between periods of time, at the end of December 31st, and then if this is annual, you're going to have some accrual at the end because you're going to get it in at the next period of time. So don't forget about that aspect of it. So let's go down and look at, we have the revenue coming in, we have the depreciation, as I mentioned, and that's the pre-tax amount. The balance sheet, you have a situation where you have an asset that needs to be depreciated, and so you have the revenue, which is coming in. They say straight line, but it's really just the total amount of the payment that's coming in that will be happening. So the lease payments will be the same as lease revenue, and also you're going to have depreciation, which is happening. Now, if it's this is the business here, is because the revenue is going to hit your books coming in. This is the first period of time. They give you a payment, and the payment is made before you've done anything to earn it. You're going to call it a deferral, and then you're going to reverse it and call it revenue. So this is the accrual business, and this is how it hits your financial statements. because it is actually a payment made up front. You can't claim it as revenue. An interesting little twist. Determine the price at which the lessor is selling the asset. Oh, okay. So this is a sales type lease. We need to go in and we need to take the present value of that stream, and we need to figure out from that what its cost must be, what its sales price is. When we compare the sales price to the cost, that would be the gross profit from that sale, because it is a sales type lease. They told us that. Don't have to do anything. They already told us that. We're going to have two effects coming in when we have sales types lease and we're the owner. We're going to have the profit that comes about from selling the item, and that hits us immediately. And then we're going to have a flow, which is the interest revenue from the financing. So those are the two things we have there. The price they're selling is a present value calculation, which gives us $280,000. They told us the cost was $230,000, so we have a selling profit of $50,000 taken at the very beginning. Then we also have interest revenue. Remember, the first payment is made up front, so we only calculated on the difference. So if you were doing journal entries, I said whenever you think about it as if it were an account receivable. If it's an accounts receivable sale transaction, you would record a debit to accounts receivable or credit to sales. You would record a debit to cost of goods sold and a credit to inventory. Okay? So I don't like it that they call that asset for lease. It's inventory, folks. This is inventory. You're taking inventory off your books and you're recording sales. Instead of accounts receivable, it's lease receivable. What is the value of the lease receivable? The lease receivable is the present value of the streams. And then at the end of the year, we are going to have some interest that needs to be accrued. A lessee who has an operating lease, they are going to make payments of $15,000. Do the journal entries. This is an excellent problem to work on, because what you need to do here is you need to go in and figure out what the present value of it is. You have $15,000, it's quarterly, the interest rate is 8 per quarter, it'd be 2%. And then the time period to use here, it says January 1st, March, June, September, and December thereafter for 8 quarters, for 2 years. So you need to use the periods when you look at your present value calculation. Let's go down and look at this. That calculates to 112,080. That means you need to record a right of use asset, you need to record a lease payable, and your first payment is made at the very beginning. After that, you're going into March. When you get into March, you make a payment. In March, you have to know that part of your payment in March is going to be interest. There's no part of this payment here interest because there's no passage of time. The trick with the operating leases is, instead of doing this journal entry, which normally you would do by dividing the 112,080 by the periods of time, taking basically straight line on it, you are going to adjust it so the total of the amortization expense and interest expense is a total of a rent or lease expense, and that is always equal to $15,000. So you have to do this little journal entry here. And, that's why I think there's a little bit of inconsistency in the way they present these things to you, because you would do this journal entry anyway, right? The difference here is the amount. And the amount is such that this and this adds at 15,000. Normally this amount here would again be 112,080 divided by the number of periods. If you're doing it quarterly, I believe, what was it, 8 quarters? Yeah, so that's the difference. we continue with this problem and we continue doing the same thing over and over again. This is an excellent problem for you to work through because you're going to develop an amortization table, and then you're going to use it. And you need to be able to work all the way through one of these problems to be able to do well on the test. This is a background information here about the old leases versus the new leases. Most of you are coming about now, and we are in the new leases. You have not had any exposure to this. And so when I use the word capital lease and finance lease, it's because my background for I do not want to tell you how many decades has been calling these finance leases capital leases. And now we are told they are finance leases. Okay, the difference also is the changes here. We had bright lines, 75%, 90%. And now they say major part, and they say substantially all. But yet when you work your problems, I want you to use the 75 and the 90. The underlying asset of a specialized nature was brought in because we realize now that there's been changes and many things are developed or created just for specific purposes. There you go, and some more terminology changes. I do not require you know any of this stuff. The financial presentation on this and how it shows up in the balance sheet is fairly important. This new bit you're just learning here to do is a new change. It used to be under the old GAAP, we recorded it as expenses, and we avoided showing it up on the balance sheet. This was so wrong because, as I said before, we actually have an obligation, therefore it's wrong for us to do it that way. And so the former way, we didn't do anything like this. This is what we do today. The former way, this chapter was much easier because your expense, your lease expense under an operating lease was only the amount of the payment, and you just did this. You didn't even have to do this table. But now, because we are required to record it as a liability, which is proper, we should, you have to do present value for them. So I'm going to skim through this. It's just that if you're interested in learning about those differences, those are the differences and the changes which came about. The outline I will discuss here. The outline, lots of this stuff is really important. The reason why we do this lease classification, and it's one of the first steps you do, is because it's substance over form. If it looks like, if it smells like, if it feels like it's really a purchase, you should show it as a purchase in your financials. It's fair, truthful representation to do that. And so you have the criteria. You need to know the criteria. That's what I'm going to say. You need to know the criteria. And if it doesn't meet those criteria, it doesn't have to meet all of them, just one of those things, then you call it an operating lease. It turns out an operating lease or a finance lease are basically the same thing if you're the lessee. The problem is, if you're the lessee, you have to make sure that you adjust the amortization on your right of use asset so that the total of it and interest is always equal to the payment. That's all the little trick you have to do there. Also, remember on an operating lease that it is excluded from the calculations of debt ratio and other debt calculations. The lessor records a receivable for a sales type lease. If there is a selling profit, that is, it's an inventory type item, you're going to have to record it as if you were removing an inventory item from your book and recording revenue. It's discussed here. Okay, operating leases. That's discussed. I've gone over it a lot. What if the lease term is uncertain? Basically, if it's reasonably certain to be exercised, then you have to look at it and you have to say, the lease has changed. If it doesn't look like it's reasonably certain to be exercised, then there's no change. Okay? And sometimes there is an event that happens that triggers everything. Whenever there's a triggering event that changes things, you have to reassess. And what does reassessment mean? It means you have to figure out if it is even the same classification of a lease. You have to go in and make the changes. So if the modification changes it so much that it looks like a new lease, you're going to have to create a new lease. And sometimes it means you change what you have into another type of a lease. Residual value. What is residual value? It's a value that's guaranteed at the end of the time period. If you guarantee and you're leasing something that'll have a certain value and you find that it doesn't have that value, then you are going to have to come up with the cash at the end. Sometimes you know in the beginning that you're going to have to come up with an additional amount. You're going to have to treat that as an additional amount to add to your PV calculations. Other times it's just a set amount and you have no way of knowing what's going to happen. You do the PV of 1 based on what's going to be there. It says here, the lessor's lease receivable includes the value of the asset expected at the end of the lease term. And then the lessee treats any cash payment that's predicted due to a guaranteed residual value as the same as if they had to make another payment. So for your purposes, know to use PV of 1 times residual value to come up with a value. Bargain purchase option, figure out where the purchase option comes in, and it has to be reasonably certain. That's why I'm calling it a bargain, okay? That you need to put it in there and consider it as a part of your present value calculation. This is very confusing in here. And then also, if there's a bargain purchase option that comes sometime in the beginning or not at the very end, then they're not going to continue to make payments. So that affects your annuity when you do your annuity calculations. All right, part C, I would say understand about the direct costs and how they are affected, and that's in your PowerPoints. Lease disclosure is extensive. I'm not going to ask you a lot about them. Sale and lease back situations. In a sale lease back, the owner of the asset sells it and then immediately leases it back. You can only permit this accounting if it's a true sale. And so if it's not a true sale and they're just trying to play around with their financial statements, then you cannot record it as a sale and then a lease back because it doesn't fit the classification of a sale. And in other words, it has to only be an operating lease. See, it cannot be a financing lease. It has to be an operating lease. Otherwise, it's just the same thing as a loan, and that's not appropriate. This talks about different types of GAAP and all of that, and this is basically a discussion of stuff that the people who had seen both types of GAAP needed to know. I'm not requiring you to know that. And that's the end of that.